From New York City for our viewers worldwide, I'm Sonali, Basak, and Bloomberg Real Yield starts right now. Coming up, hot inflation puts a dent into Fed rate cut expectations, and yields surge as traders readjust their positioning. And Bruce Richards is going to join us to discuss the state of the credit market. But we begin first with the big issue, the Fed's inflation fight.
You know, inflation is taking its time coming down.
Inflation's a sticky animal.
Perhaps inflation may remain high.
February was only a little bit better than January,
but still not good.
And look at the bigger picture.
The Fed can get down to its 2% target.
The broader trends in inflation and core are moving down.
I don't think the Fed takes a lot of signal from one or two inflation prints after a series of very good inflation prints.
Shifting its focus from the month-to-month gyrations in the data.
The Fed's still likely to cut 3 times this year.
Will we start this summer is still out there to be seen.
We have the first cut starting in June.
June, July.
I don't think we're going to get into rate cuts, certainly not next week.
I wouldn't expect huge changes from the statement next week or from what Chair Powell says in his press conference relative to what they've been saying recently.
Now, ahead of a major FOMC meeting next week, remember, traders are really already not thinking about cuts earlier on in the year, and they're pushing their expectations out. But how far out? Remember, just 2 months ago, we were looking at about 4 rate cuts priced in by July 31st, and that has already gone down to 1. And remember, when you look at Fed futures, the probability has declined meaningfully. It was priced into nearly 100% just 2 months ago, and now you're looking at it at about a flip of a coin. So let's look at the moves here in the Treasury market. Flip up the board. The 10-year has had some really drastic moves this year. You are seeing the biggest gain in yields since October. And if you think about just how much that has been, it has been one of the drastic moves, the more drastic moves we've seen over the span of the past 6 months. Now, remember, there are a lot of influences to that move in the longer end of the curve, and we're going to talk all about it. Joining us now is Karissa McDonough of Community Bank and Collin Martin of Charles Schwab. Karissa, when you think about the data that we have seen and just how far yields have flown higher on the 2-year, on the 10-year, and the data that we're going to get ahead before July, when traders are expecting a cut finally, how do you view that data and the uncertainty around it?
Oh, thanks so much. I want to just step back and kind of paint the bigger picture for the viewers for a minute. We're talking about, well, is there 2 cuts in 2024, 3 cuts? We had assumed 6 cuts even, 6 months ago. The bigger picture is the Fed has engineered a very masterful exit from a very tight policy. Like, inflation is half of what it had been. So there is certainly a degree of uncertainty about what is going to happen in the next 6 months or so. We think possibly 2 to 3 cuts. But that's really, again, missing the bigger picture here where, these types of gyrations in yields, that is what you see during an inflection point in the market. And that has a lot to do with kind of tighter liquidity and the fact that it's the marginal trader making these rate cut bets. And most people seem to be already positioned. And we think the logical positioning is, yes, there will be rate cuts. Maybe it'll be shallower and quicker than otherwise what we had expected. But the logical positioning remains, kind of long duration in anticipation of a steeper yield curve.
Collin, curious about your thoughts on this. Maybe this is even a very unfair question given the volatility we've had. But where at this point do you think Fed funds end 2025?
Oh, 2025, we're probably still in the kind of the mid-3 range. If we look ahead to next week, we're going to get those updated projections. There might be a change in 2024. I don't think there'll be much of a change in 2025. If we look at kind of the noisy data we've seen lately, yes, it's been noisy. Yes, it's been a little hotter than expected. But we think that the trend will ultimately continue. So for us, it's more about the timing of those rate cuts and whether it's 2 or 3 this year. I think that's to be determined when we get those inflation readings over the next few months. As we look ahead, though, we think it will continue. We're seeing plenty of slowing down underneath the surface. Inflation was the hot topic this week with both CPI and PPI. But what was happening along with that was a relatively weak retail sales following what was another weak retail sales in January. We're seeing surveys continue to decline, and we're starting to see more balance in the labor market with that unemployment rate getting up to 3.9%. So I think if we look ahead, I think mid-threes is probably our best approximation right now, but as everyone says, it all comes down to the data.
Now, I want to read a quote here from Ken Griffin earlier this week. He says, pausing and then changing direction back toward higher rates quickly, that would, in my opinion, be the most devastating course of action to pursue. So I think they're going to be a bit slower than people were expecting. Karissa, when you think about what Ken Griffin is saying, this idea of what causes the Fed to cut, do you think it's going to be meaningful progress on inflation, or to the point that Collin's making here, this idea that the data, the economic data, is getting weaker and potentially can get much weaker?
Yes, that's an excellent setup. For sure, it's not just one or two data points. It's really, and it's not just inflation, although certainly the 2% target is their primary target. They are walking a tightrope between making sure that they're bringing inflation down to a normalized, like long-term level that we can live with economically, while making sure that we're not sending this economy into a recession. Now, we're not sure if we're going to see, a slowdown or an outright recession, but that's really the tightrope that the Fed is looking at. So they're not just looking at the inflation data. As Collin had said, they're looking at a whole range of data. And for that reason, Powell is going to be very careful about how he proceeds, which is why these rate cut expectations continue to get pushed out. He's been very deliberate, and rightfully so.
You think, Collin, about the data that we are seeing and the gentle weakening, let's call it, of some of the things that we're seeing. Do you think that things can get worse? And do you think that there's a longer horizon here, given the expectation for elevated rates?
I think they can get worse, but we're not in the camp that we're going to see a recession soon. We have come around to the idea that a soft landing does seem the most likely. When you look at the Fed's reaction function and how the markets and the economy is handling that, we see both consumers and corporations have handled the rise really well, mainly because of how they've managed their balance sheets, with corporations pushing back their maturities, and a lot of homeowners or people who've locked in low rates, the rise in rates hasn't really impacted them. So we're looking more at a gradual slowdown, because we still do subscribe to the idea that a high real rate is going to weigh on activity. And we're focusing on that real rate. A lot of people talk about it. The idea of cuts coming up is not necessarily to stimulate, it's more to just maintain. But if inflation does keep coming down and that real rate rises to 3%, 3.5%, that's a challenge for consumers and it's a challenge for corporations. So we do think that slowdown should eventually come, but not a sharp recession.
Now, Collin, real quick here, because you pointed to the inflation data that we've already seen. What about the future inflation data? Do you worry about risks to upside here for inflation?
I think we do, and I think it was Basak last week that addressed that. The idea of a premature cut that stimulates demand and fuels a reacceleration of inflation. It's not our base case right now. We think kind of worst case is maybe it levels off here, but we do think it should continue. I would agree with the quote you led with before about the risk of maybe inflation reaccelerating and the need to begin hiking rates again. I think that would be bad for the economy, it'd be bad for risk assets. And I think the Fed is very tuned into that idea. And it really goes along with the idea that they want to take a patient and thoughtful approach rather than risking premature cutting rates.
It almost gives some credence to slower for longer. Karissa, if you think about what we were talking about with the recession views here, potential softening of the economy, what is your view on how bad really things can get if we don't get to rate cuts this year?
I think back to the point about the real rate being restrictive and causing the economy to slow, I think it is a real risk. And I think the Fed is very tuned into that. The last thing they want to do is kind of go too far afield on fighting inflation so that they veer the economy into a recession. That's a real concern. There are a couple things that I'm sure they're looking at. The labor market, it continues to be solid, but there are signs of weakening there as well. Bank balance sheets are really impacted by these higher rates, and banks are not quite as able to make money with this inverted curve. These are things that they're all looking at, and again, it would be helpful to have at least one, if not two, cuts this year. We're not in the camp that we think that inflation is going to meaningfully reaccelerate either.
How do you look at, you mentioned duration might be the play here, Karissa. I mean, how far do you go out on duration at this point, given all the uncertainty that's still in the market?
I think anywhere outside of, say, the 10-year Treasury, so you're looking at maybe north of 5 years, which is, the AG's duration. Anything kind of longer than that, we don't expect that you would see a significant additional move upwards in yields here, even with a couple more, say, hot inflation headline numbers. We think, again, that those coupons, you're not going to be able to source those north of 4% coupons for too much longer with a cutting Fed. So this would be the time to load up your portfolios with that. That's how we're advising clients to invest, because the natural shape of the curve over time with this policy coming into place is going to be a bullish steepener, and we will see, those rates start to come down.
Longest inversion in history. Karissa McDonough and Collin Martin, we thank you so much for your time. Now, up next, the auction block. Automakers like VW and Aston Martin add some style and speed to this week's issuance. The global pace of issuance remains red hot. And we're going to talk about credit markets with Bruce Richards, Chair and CEO of Marathon Asset Management. That's all up next on Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. And it's time now for the auction block, where we are on a record quarterly pace for issuance in Europe and the United States. And this week in UK helped fuel what would be a record when it sold a £4 billion offering of a 30-year inflation-linked debt note. It saw orders of more than £56 billion, an all-time high for that class of securities. And there was a British feel to U.S. high-yield sales this week, with Aston Martin selling debt in pounds and dollars to help refinance existing notes. The $960 million 5-year tranche saw an order book over 5 times covered. And automakers also helping to fuel U.S. high-grade weekly sales. You saw names like Volkswagen and Hyundai, along with Goldman Sachs Bank's USA's first sale since 2019, driving the total to over $37 billion. And sticking with credit, King Street's Brian Higgins seeing a lot of refinancing that needs to happen. I spoke with him yesterday.
As you go into year end, you'll start beginning slowing. I think it will be ultimately looked at as no landing, soft landing, progressing into a harder landing. There's a lot of refinancing that needs to go on. It's on the real estate side, on the corporate credit side. If new issue cranks up, as it has been doing the first couple months of the year, then investors will have a choice. They'll say, why do I own this in my portfolio? This is much more attractive. A little bit less leverage, a little bit better industry, less cyclicality. And so that will mean they'll toss out some of the more marginal credits.
Now let's bring in Bruce Richards, CEO of Marathon Asset Management, who of course watches all of these markets very closely, in and out of them every day. Bruce, when you think about this idea that interest rates could stay higher for longer, the reality now that even a summer rate cut is at the flip of a coin, really, how do you think through that uncertainty and how it impacts the way you're investing?
Well, first, the Fed meets next week, and this Sunday is March Madness, and so the March Madness comes next Wednesday will be real, because we'll be looking to skew, we'll be looking to mean, the median, where the dots are, 2 or 3, what the Fed does. Powell's been talking about the bump, and the bump isn't really a bump, because a bump means it's coming back down, and right now it looks like for the last couple months it just smoothed out and plateauing now, moving sideways at this 3.5% CPI, 3% PPI. So will the Fed move come June? And you're absolutely right, Sonali. I think it's 50-50. And so this higher for longer is real. I think Brian's right. I think your implication of that question that you asked is right, because I think it will be higher for longer and will have a major impact on a bunch of different cohorts in the marketplace.
Let's talk about those cohorts. Of the ones you think that are going to be most drastically impacted, where do you think most of the pain will be?
Well, I think there's 4 cohorts just to define them. So number one is CRE, the top, very top, that's most levered to rates. Number 2, there's companies, and 3, there's banks, and 4th, there's the consumer. So you want to unpack each one, or do you want to
Yeah, let's start actually
one?
there with one specific part, because let's start with companies, because
Okay.
you look at the market today and spreads are super tight. You look at the market and you think from high grade to investment grade here, or junk bonds rather, you are looking at people who believe that nothing is going to go wrong in this economy. Do you agree with them?
No, absolutely not. I mean, the IG market is, pretty tight. It's, pushing up against all-time tights, and high yield bond spreads are also very, very tight. And so they're just too tight for the risk, I think, in the marketplace. And I think they are vulnerable. But with these tighter spreads and the easing of financial conditions, maybe not Fed funds rate, but an easing of financial conditions, it's the year of the refi. And it's going to be like huge, huge volume all year long for IG and high yield companies. So within that, there's a mix, right? So you have the 90% that will do well. First of all, big companies are going to do very well in this environment because high rates and low financing costs allow them to make a really nice return on their cash. It's the 10% of the tale of two cities that's the other side of the equation that's struggling. And so take a look at like some of these software buyout companies and healthcare buyout companies and some of the retailers. I just came on just a minute ago, right before I was checking out my emails and going through my inbox. S&P just released a report that I'm going to have my team print out when I get back that shows 29 companies this calendar year already, the fastest pace of defaults since 2009, this calendar year. We don't read about it. We don't talk about it. I recently posted about Enviva, who just filed for bankruptcy, a green company that's not so green, that, blake cash. And so there's lots of companies that are over-levered. Anthology, Quest, two big software companies in the buyout space that were supposed to be leveraged 8 to 10 times, positive EBITDA, didn't grow into their models. And for their forecasts, and so are levered about 15 times debt to EBITDA.
It begs the question here, we have not really seen a real distress cycle. And do you think that one is still coming?
So there's $5 trillion of debt between high yield and loans, US and Europe. And we think there's around 400 to 500 billion that will be restructured. So you can say there's no cycle because there hasn't been a recession, but last year was a pretty decent year for distressed and dislocation with about $180 billion that went through restructuring. And this year, we think that number going into next year, in the next 2 years, could be $350 billion or double that. So we're calling for $500 billion, and that'll be bigger or just as big as what happened in 2008 and 2009. Maybe not in percentage term, because the markets have grown since then, but in absolute volume terms. And so we're seeing that again in software and retail and in healthcare companies and across industries that are too levered.
It's pretty incredible here. If you think about what you're drawing out, this idea that you'll see more bankruptcies, this idea that more companies may face restructurings, this idea that more of corporate America is now laying off more individuals. Do you think that the data can either get much softer for economic data, or do you think that it's masking some of the problems that we're seeing already in the economy?
Well, the masking is coming from the big government spending and those huge deficits that we're running, because a lot of growth is coming from that part of the equation. And corporate America, it's, again, a tale of two cities. You have S&P, which is up 8%. You have, IWM, which is Russell 2000, which is flat on the year. And you have a lot of companies that are levered, that are burning cash just to service debt. And if you look at the Moody's report and you look at the B3 rated companies, there's a big cohort, somewhere around 35 to 50% of companies that have to burn cash just to service their debt. So that's the tale of two cities that exists. We see that in CRE as well. We see that with the banks. The big banks are really safe and fortress balance sheets, JP Morgan, Bank of America, Citi, Wells, and the big trust banks like Northern Trust and State Street and Bank of New York, they're fortress balance sheets, really safe. But there's 4,400 banks in this country, and it's the 90-10 rule. About 10% of those have really high funding costs in the double digits, and in addition to that, have balance sheets which are really troubled because they have about 40 to 50% in real estate. And so we think they're already insolvent or moving towards insolvency, and the industry will continue to consolidate. So it's happening in the banking sector, it's happening in the corporate sector, it's happening in real estate, it's also happening with consumers. We see delinquency rates among consumers for both autos and credit cards having surged from less than 2% to over 6% today in the last 12 months. So you're seeing this tale of two cities play out at these higher rates.
Now, I want to talk about real estate more because you have very divergent views here. You have some people saying that you don't really have a floor yet when it comes to property values, when it comes to commercial real estate more broadly. You have Blackstone saying real estate prices have bottomed and it's an opportunity to buy. On that spectrum, where do you stand?
Well, I wouldn't argue with Jonathan Gray, because he's a pretty brilliant guy, and Blackstone has a lot of very good on-ground data, but let me share with you the data that we have. So there's about 21 to 22 trillion of real estate in the market, and a lot of companies own their own real estate, and so they finance it on balance sheet as opposed to putting debt on it. But the $8 trillion of property that is financed with $5.6 trillion of debt, a lot of that is upside down. How much of that is upside down? Well, Barry Sternlicht says it's $1 trillion. We'd actually agree with Barry. We think it's about $1 trillion that's upside down, where the equities are basically depleted, where that $100 million property, $70 million loan is only worth $70 million. And so either the sponsor has to come up with more money to roll that, or they're going to have to flip the keys or lose their property. So here's the punchline, Sonali. So this year, it's a record. And look at that record wall. You have $900 billion of debt coming due this year when there's only supposed to be $540 billion debt coming due this year. Why? Because a lot of those loans, hundreds of billions, got extended and amended or kicked the can down the road into this year because they couldn't refinance. The markets are open, and the big question is, can they refinance? Take that $100 million property, a $70 million loan with no equity left, and it's a Class B or C office building.
Right.
What's the alternative use? It's raising that building, taking it down to land value, which means it's only worth probably 30 cents on the dollar.
Well, that is a note to leave it on, Bruce, and we will have to have you back soon as we head in that direction. Wall Street has become pretty expert here at kicking the can down the road. Now, still ahead, the final spread. It's a big week ahead for monetary policy, a pivotal week, really. We'll talk about all that data coming up next. This is Real Yield on Bloomberg. I'm Sonali Basak, and this is Bloomberg Real Yield. It's time now for the final spread. The week ahead, coming up, a lot of economic data coming out of China, industrial production and retail sales, and a Bank of Japan decision on Tuesday. And Wednesday is the Fed's turn, that big Fed decision with a lot of eyes on the dot plot. Plus, of course, we'll hear from Fed Chair Jerome Powell. BOE decision out on Thursday, as well as an IPO. Let's talk, though, about just how much we're going to see out of the world central banks. Monetary policy for 40% of the world's GDP coming out next week. Of course, the BOJ, BOE, and the Fed being highly watched, but there are, of course, many others. We'll keep an eye on all of that for you throughout next week. From New York, that does it from us. Same time, same place next week. This was Bloomberg Real Yield, and this is Bloomberg.